Say thank you to everyone who's taken time out of their day. Fritz and I were chatting a little bit before we started here that I didn't have this bank. I didn't plan the banking. I don't like the word crisis. I don't necessarily would utilize that word, but some of the challenges that banks are facing, I didn't plan that in advance to make Fritz's comments more relevant. So just as a disclaimer, but we're glad that Fritz is here. Sometimes life convenes conveniently for us in these moments. So I first heard Fritz speak, 6 years ago, 7 years ago, everything with COVID blends. And being an advisor for nearly 20 years, I've had the distinct privilege of hearing many economists speak. And one of the things that I thought Fritz did uniquely is being able to take the complex and break it down in a way that was understandable and approachable. And so I hope that you find what Fritz has to share with you today, taking the complexities of the economy, specifically in this current environment, and make them easier to understand and build confidence and clarity in each of you who are spending time with us today. So let me give you a little bit of background on Fritz and why I think he's an incredible asset to have on us today. So Fritz Myers is an economist and market commentator. He publishes a periodic updates and opinions on the economy, market, and investment strategy. I take his newsletter. It's great stuff. He's been a frequent guest on CNBC, Bloomberg, Fox Business Network, and he's often been quoted in financial and business publications and regularly speaks to financial advisors like myself and their clients. So this is not his first time doing this, is what I'm suggesting. So prior to starting his own firm in 2011, Mr. Meyer spent 15 years with Invesco and began his investment career in 1976. I know he looks like he's 25. He's been doing this for a little bit. He's seen it, right? Not something he's just studied in a book. And he was an Invesco senior market strategist and has managed large cap equity mutual funds and multi-cap equity and fixed income client portfolios. So what that means is he hasn't just studied this in a book. He's applied his theories and making decisions upon and on the benefit of clients at a very high and large scale basis. He earned his AB degree from Dartmouth College with a distinction in economics and his MBA degree from the Amos Tuck School at Dartmouth College. So without any further ado, I present all of you Fritz Meyer, and thank you so much for being here today, and I'll let you take it away from here.
Okay. Kyle, I'm going to share my screen and put my slides up. Give me 1 second. And tell me if you see a full screen view.
Looks great. It looks great. If there's anything that cuts off, I'll let you know.
Okay, terrific. I'm going to spend maybe 45 minutes talking about the economy and the markets and some comments on investment strategy. I thought I'd start here today talking about Kyle said, crisis is probably not the right word, and I agree with that. I don't think it's a banking crisis, generally speaking. I think there are a couple of banking companies that are in crisis. The bank term funding program that the Federal Reserve rolled out in response to Silicon Valley Bank's bank run was indeed a powerful weapon. And so I just thought I'd put that up here, the terms of the bank term funding program, and just quote the relevant description. The additional funding will be made available through the creation of the bank term funding program, offering loans of up to 1 year in length to banks. And these assets will be valued at par, which is a crucial statement. So the problem that Silicon Valley Bank faced was a mismatch of maturities between their deposits and their assets. And so to the extent that the Federal Reserve lends cash to banking companies that are in crisis of this manner at valuing those securities at par is a crucial aspect or element of this program. Then the question is, well, what effect will this crisis have on the economy more broadly? And of course, nobody knows at this point, but here was a terrific article in the Wall Street Journal from yesterday. Banking mess raises recession risk. Main Street businesses and American families are likely to find it harder to get a loan because of the turmoil in the banking industry. And I'm just reading this because I think it's important. If it's suddenly much harder to get an auto loan, a consumer loan, a mortgage for commercial real estate simply because smaller regional banks have to reorganize balance sheets, then you run the risk that many people won't get the financing to buy that car, to buy that washer, and that corporate lending takes a hit. So this is the concern that people have. And the last statement that I just wanted to point to in this article is that Goldman Sachs economists increase the probability that the economy enters a recession in the next 12 months to 35% from 25% before the SVB failure. Now that strikes me as a fairly low percent on the part of Goldman Sachs. And I'm citing Goldman Sachs because they are probably one of the preeminent Wall Street firms. And so that's a pretty encouraging statement to me, a 35% probability of recession, because if you watch CNBC, for example, you'll hear a lot of people come on and say, "Oh, we're headed for a recession," very definitely. But that's not the case in the case of Goldman Sachs. And my personal view is that I'm in the soft landing camp. I think that for reasons that I'll discuss here, most importantly, the fact that we still got very strong new job formation in the United States. And until that single aspect changes, my own view is that we probably skirt recession, and we don't have a serious problem resulting from this so-called banking crisis. So let's turn to the economy, and I just wanted to show you this cover from Barron's magazine, The Wacky U.S. Economy, and what everyone got wrong and so forth. But the wacky economy is what I wanted to focus on. The Wall Street Journal had an article entitled "The Split Personality," the Split Screen Economy, and I guess I dubbed it the Split Personality Economy. It's like we're watching two different movies, or you can watch two football games in one screen and you can see two entirely different stories playing out. And that's what I wanted to highlight here today. The divergence in the economic news is striking. In other words, there's bad news, the index of leading economic indicators and the inverted yield curve, which I'll talk about in more detail in a second, clearly suggesting we're headed for recession. And yet the list of good news is longer than the list of bad news. And I think probably the good news trumps the bad news. But again, that's just a personal view. And all I can say is we shall see. So let's go through the list of bad news, and then we'll go through the list of good news. And you will have to make your own determination as to what you think is going to happen based on this analysis. This is the index of leading economic indicators. And you can see that the blue line in this chart has trended down well before the onset of recession. So it's been an accurate indicator. And as you can see on the right side of this, right side of the screen, the conference board said we will most likely will most likely push the economy into recession in the near term. That's their interpretation of the index of leading economic indicators. Wow. The LEI for the US fell again in February, marking its 11th consecutive monthly decline. Wow. So very negative indicator in the LEI, and the LEI has been pretty darned accurate over time. Similarly, the yield curve, so-called, in the red data series here, the differential between the yield on the 10-year Treasury bond and the yield on the Fed funds, suggesting that when it goes negative, it too has been an accurate indicator that we're headed for a recession. There's one, it hasn't, just trying to make my pointer work here. There was one false reading here where the red line went below 0 and we didn't have a recession, but except for that exception, then the yield curve has been also an accurate harbinger of the onset of recession and a bear market in stocks. So those two things, the index of leading economic indicators and the yield curve, strongly suggesting recession. Then we have the ISM Purchasing Managers Index for manufacturing dipping below 50, clearly a sign of weakness in manufacturing. Housing starts have come off very dramatically off of a 1,805 to 1,450 run rate. So housing starts losing lots of momentum. And retail sales, here's an article from just a couple of days ago. US economy shows signs of cooling. Retail spending fell and price pressures eased in February, but Fed's focus has shifted. A drop in retail sales and easing price pressures offered preliminary signs of a cooling economy. So that's the list of the negatives. Now let me go through the good news. We have, first of all, the Wall Street Journal surveys 60 of the best and brightest economists, and their most recent survey concluded that no, in fact, we won't have a recession. They're forecasting a mild contraction in the second quarter, as you can see in this chart, but no recession. I found that very interesting. Secondly, and this is really an eye-opener, the Atlanta Fed does a econometric model called GDP Now, and from coming off of 2.9% growth, GDP growth in the fourth quarter, they're forecasting 3.2% here in the first quarter of 2023. Wow, that is a very strong momentum. And that's based on, again, their econometric model, which has all sorts of inputs, and I can't tell you exactly, what
And
those
Fritz,
are.
what's normal, like for our economy? Where have we operated from 3.2 in a vacuum, but
Yeah,
historically, where does that come at?
the calculated rate of potential GDP growth is about 1.9%. So that would be the norm. And interestingly, Kyle, in this picture, you can see also where the blue chip consensus currently rests, which is less than 1%. And yet this Atlanta Fed GDP Now econometric model saying 3.2%. Lots of momentum in the economy is what they're saying. The ISM Services Purchasing Managers Index dipped, as you can see here, in December, but then sprang back very forcefully such that we're at a normal run rate for the ISM Services Purchasing Managers Index. And unlike the manufacturing PMI, this one captures 89% of the US economy. And so this is the more important of the two Purchasing Managers Index, and it's suggesting healthy economic expansion. Car sales are coming back, having declined very dramatically over the last couple of years in response to a shortage of semiconductors. So car sales are recovering. That's good news for the economy. And then probably the single most important factor, and the reason that I'm in the soft landing camp, is new job formation of 311,000 net new jobs. And so economists would say, how can you have a recession when you're having such powerful new job formation, people earning paychecks, cash available to spend in the economy?
One of the things that gets questioned is, do we have a sense yet where, because there was a concern, or at least a handful of years ago, about available workers, right? Is a decreasing labor force in the United States, and you see job seekers, that number staying, or at least from what I've seen, maybe you've got better data than what I'm seeing, but job seekers not, where are we getting these gains? How are we employing people when it seems like there's not as many people interested in working these days? Observationally, maybe my data's wrong on that.
No, an excellent observation. And so I just went forward to this chart. You can see that today we have 10.8 million job openings and 5.9 million job seekers. So where are we getting them? Well, the participation rate is gradually recovering, but gradual is the operative phrase there. I don't have the participation rate here, but basically we're slowly regaining some of the jobs. The people that left the labor force are slowly coming back into the labor force, but it's been a very difficult proposition. There's so many more job openings than there are job seekers, but this is one reason that I think probably new job formation remains strong, because there are so many unfilled openings.
And for those the participation rate, for those who are unfamiliar, is just it's a measurement of the available. Think of our old fourth grade, like my daughter's learning fractions and just went through fractions in the fourth grade. So the participation rate's just a fraction. We got a denominator, which is, I think, and correct me if I'm wrong, Fritz, but I think it's 18 to 65 non-incarcerated individuals. So we've got an able workforce. What percentage of those folks are actually employed? And we get a percentage. And that's what's called the labor force participation rate. And that gives us an essence. It's very different than the unemployment rate, because those folks fall off over time. That data is much more accurate in giving us an understanding of the health of the overall labor force.
Right. So hiring economy shows surprising resilience, and the unemployment rate here at a near record low too suggests to many economists that how can you have a recession when the unemployment rate is near record all-time lows. One of the other aspects to this economy that I think is important is the wealth effect, so-called, and what we're seeing here is household net worth has surged. It came off just a little bit and then surged again, or is recovered again. And the reason this is important is, to the extent that Americans feel wealthier from a balance sheet standpoint, they tend to spend money more readily. And so the wealth effect is real, and it's just another positive tailwind for the US economy, as is this statistic, the financial obligations ratio. A lower number here is better than a higher number. What you're looking at is what percent of monthly after-tax income the average household has to pay on fixed recurring monthly obligations, like a mortgage payment, a car payment, credit card payment, utility bills, homeowners insurance, all those things that we have to pay every month as a percent of monthly after-tax income. And as I said, a lower number is better than a higher number, suggesting that Americans are, generally speaking, in pretty good condition to keep making discretionary spending decisions. And also the money supply in the red data series in this chart surged, and we're still seeing a very elevated number there. So this suggests that Americans' checking accounts are still pretty darn flush as a result of the CARES Act and subsequent stimulus. So cash available to spend. And then the question is, and the bears on the economy would say, well, how long is it going to be before that runs out? And most economists say, well, probably another 6 months, or at least 6 months, maybe a year, before Americans start running down their excess savings, is what that's being called.
And so this is where the economy has been able to stand strong in the face of inflation, right? This is one of the things, as I'm reading, that, well, how can inflation's been the headline grabber for folks who don't take the journal. At least most folks know that that's occurring at a higher clip than we've experienced in 40 years. The question is begged, then how is the economy not collapsed into recession? That excess savings that has been there, it hasn't been the credit cards that Americans have had to lean on. It's the excess cash that we've been able to cover higher groceries, right? I mean, higher egg prices, I think, is the newest meme out there about the economy. That's where that's all been absorbed. Am I wrong to make that statement?
Yeah, no, I think that's correct. And then one of the last positive factors that shouldn't be overlooked is that crude oil prices have come way off. So that means lower gasoline prices, and that helps Americans spend money. So those are the positives. And as I say, the single most important positive, at least in my mind, is net new job formation. And so long as the number of unfilled jobs remains so strong, I think we're going to continue to see healthy new job formation. And that to me trumps the index of leading economic indicators and the yield curve in the force that it exerts on the US economy. And so that's why my own view is that we probably skirt recession, and corporate earnings hold up reasonably well, which is another topic that I'm going to talk about. Let's shift gears and talk about the stock market for a second. One of the questions that I had going back to the election is, what happens in midterm election years in the stock market? And it's just a really interesting chart. That's why I wanted to show it to you. It's a very busy chart, but all of the numbers under the years are the answer to the question, what percent change in the stock market have we seen 3, 6, and 12 months from the day of elections? So the bottom line with this chart is to suggest that midterm election years have actually been very good for the stock market. You can't find any negative numbers in the history of midterm election years for the stock market. So for whatever reason, here's the stock market itself. And just a couple of observations. First, a very simple-minded view, but I think something that we shouldn't overlook is that 2021, if you can see the cursor, was an absolutely extraordinary year in the stock market, up 34%, dividends included, in 2021. So it shouldn't be any surprise that you give something back after a year like that. For a variety of reasons, the market just went skyward. And again, it's no surprise that we're giving something back and we're seeing some correction from that. My simple-minded analysis is that if you just put a ruler on the stock market and went up like this, we are about where we should be, it seems to me, following that correction that we saw last year. Second observation is that the bears on the market think that we'll take out the October lows. You can see the October low of 34.91. This is the S&P 500. And the bears on the market think, well, we haven't seen the bottom yet. The bulls are arguing that and saying we've probably seen the bottom for this bear market cycle. And I would personally fall into that camp. I think probably that was the worst that we'll see. And then finally, 4,000 is, we're not far from 4,000 today. The chart is a couple of weeks old. We're not far from 4,000 today on the S&P 500. And just the observation that at the beginning of this year, if you canvassed all of the strategists in Wall Street, they were saying their target for the end of this year on average was 4,000. So in Wall Street, nobody was or is expecting much from the stock market this year. Personally, I think we'll probably do a little bit better than that by the end of this year, and for a reason that I'll explain in a little while. One of the most important charts to take away from today is this one. Whether or not we fall into recession, the history suggests that the stock market eventually shrugs it off and moves higher. So this S&P 500 versus recessions chart is so crucial to understand that that it's very difficult to try to trade stocks around a recession. In other words, try to sell them high before we slip towards recession, and then know when to buy them back. And you can see that the stock market historically has bottomed. In this case, if you can see the cursor, it bottomed 6 months before the end of recession, and here 3 months before the end of recession, which means that even as the news flow is the absolute worst, the stock market will start higher and start recovering, which is so incredible and so makes it so difficult to try to time the market in and around recessions. And so my attitude is, don't try to time it, just stay fully invested through the economic cycle, and you'll do just fine because the stock market, as I said, shrugs it off and starts moving higher well before the end of recession historically. Here's another chart that in the same vein, S&P 500 and crises. Kyle was saying that this may or may not be a crisis, a banking crisis, but maybe I should put SVB on here. The most recent crisis that I identified was the Ukraine invasion. But again, the point is that the stock market shrugs off crises, historically at least, and this goes back to 1957. You can see other banking crises, Franklin National, Penn Central, other similar, Continental Illinois, other similar financial crises, and yet the stock market eventually moves higher, moves past the crisis du jour. The other thing about this chart is what you can see is what a real bubble looked like. And some people were saying in the last couple of years, we were experiencing a bubble. And yes, maybe to the extent that you can see here, we had a mini bubble, but we clearly don't have one today. The stock market is about, as I said, about where one would expect it to be. The subject of volatility, I think, is an important one. You can see that volatility, measured volatility, has been trending higher, or at least has been higher than it was back here in 2021, when the market was just moving higher consistently, and suddenly we get a lot of bumpiness, a lot of hitting air pockets in the stock market. And this is what people hate about investing in stocks to begin with. You come home and the Dow is down 1,000 points, 5.5% in one day. Wow, it just doesn't feel very good. But here's the important point that I think is so important to focus on. The basic axiom of investing in common stocks is that over the long term, investors earn the equity risk premium precisely because they expose themselves to price volatility, also known as risk. The way we measure risk in the stock market is standard deviation of return. So it's a measure of volatility. But the equity risk premium that I'm talking about is that in the long term, stocks have done about 10% compounded annually over the long term, and fixed income about 4%. So 6 percentage points is the equity risk premium that we've earned in stocks precisely because we choose to expose a portion of our portfolios to an asset class that's volatile. It's a different way of looking at stocks, I think. It's saying to yourself from the outset, if I want to earn the equity risk premium, I have to identify an asset class that's going to be volatile. I'm seeking out volatility. So hooray for the return of volatility, because if volatility disappeared, then equity returns would probably converge with bond yields. So important.
I think that's one of the most important learning lessons people could take away from this discussion, right? Like, yeah. It's the price you pay. That's ultimately the price you pay to get the return we all want, right? Yeah. Is that you might wake up tomorrow and what you own today is worth less tomorrow than it was today. That doesn't feel good for anyone, right? I mean, it really truly doesn't. But in absence of that, if that would go away tomorrow, then we could assure that the rates of returns for equities, stocks, would converge with those of bonds. And so why would you own these things if that's the end game, right? And so this understanding, and this understanding is so true, you can actually calculate it. Like, what's the rate of return over the risk-free rate? Geeks like Fritz and I have learned these calculations and these models in our undergraduate and graduate degrees. And so, this is such a true statement. You can actually calculate that return. There's formulas for doing so. So I appreciate this. Is one of my, when I saw what you're going to share with us today, one of my favorite things to help people understand is that there's a gift in the discomfort, which is the results.
That's right. In other words, if you want the return, you have to take the risk. And so hooray for the return of volatility when it occurs, because without it, you wouldn't get the equity risk premium. Thanks. This chart, I just think is so important. The red line is the S&P 500 total return index. That means that you're including dividends and reinvesting dividends. Well, the first point is that I'd make is that the black line is the S&P 500 price index. So if you looked right now at where the S&P 500 is, that would be the black line, but the red line includes dividends reinvested. So point number one about this slide is that $100 invested in 91 in the price index worth $1,000 and almost twice that when you include dividends reinvested. So the importance of dividends to total return in the stock market long term can't be overstated. And so in my mind, then the core of any equity portfolio would be a high quality dividend growth strategy where you're capitalizing on the dividend effect and contribution to long-term return. Second point is that the red line really looks like it's been doing something crazy in recent years. In other words, ever since the bottom here in 2009, where the cursor is, the stock market appears to have just been going crazy, straight up. And some people had been saying that, well, it's going to end badly because stocks can't just go straight to the moon without then giving a lot back, having some kind of a big crash in the stock market. The point that I want to make is that the problem with this chart is you're plotting the data on a linear scale over here. It's a linear scale. Just go back to high school algebra and ask yourself, if you compound a data series at a constant rate, then what is this 10% growth path ultimately going to do? It's going to converge with an asymptote, which is a vertical line, which is to say that if this chart looks wacky now, it's going to look a lot wackier in another 10 years when it looks like it'll be going perfectly vertical. If we replot the data on a logarithmic scale, you get an entirely different view of the stock market. The stock market has been doing exactly what one would expect it to be doing. And in the previous slide, I was referring to Jeremy Siegel, not just over the last 30 years, but over the last 200 years of US financial history. Professor Siegel recreated stock indices going back to the beginning of the United States, finding that 10% has been the magic number for common stocks over 200 years of US financial history. And lo and behold, today, they look like they're right on where they should be given the 10% long-term growth path. Having been ahead of that, you see in the last couple of years, we did have a mini bubble here, and you can see what a real excessively valued stock market looked like back here in the 90s and the year 2000. But today, stocks are right on that long-term trajectory. And another reason that I feel that stocks are fairly valued. They're neither over or undervalued at present. Let's take that same concept back to 1935 in this chart, and you're seeing that the red line is the S&P 500 total return index, again, trending higher at between 10 and 11% over the last 85 years. Just a really impressive chart, and not without volatility, of course. And you can have years and periods when you don't do 10%, you go sideways, but the long-term trend rate of appreciation is somewhere between 10 and 11% on the stock market. My question, when I've looked at this chart historically, is, okay, so what accounts for this incredible engine of wealth creation here in the United States known as the stock market? And the answer is that earnings drive stock prices. Earnings here, going back in the same time period, going back 85 years, compounding at between 6 and 7%, driving stock price appreciation of between 6 and 7%, and then you add the dividends and you get to the 10% number. So let's talk about earnings today. This is the current earnings forecast, and Well, I guess the most important aspect to this chart to point out is that analysts who are arriving at these earnings estimates are not hearing from companies that they believe recession is on the horizon. In other words, this is not a recession earnings forecast. If it were, you would see a dramatic downtick in earnings that occurs during recession, but rather a slowing in the rate of growth in earnings followed by a reacceleration in 2024. So again, most analysts then are hearing from companies. The source of this data, remember, is that legion of analysts in Wall Street who follow the 500 companies in the S&P 500 who talk to chief financial officers every week asking them, how's business? And evidently the answers they're getting are business remains solid.
So this is very different than our weatherman or weatherwoman that comes on the TV and is predicting what the weather's going to look more than 10 days out. This is not what I'm hearing you say here, Fritz, in this particular chart. This is direct conversations with lead decision makers at the 500 largest companies in the United States by market capitalization. And they're saying, we don't expect earnings to go down. We just expect earnings to grow a little slower than we did 12 months ago. Which is very, very different than a recession. Is that the takeaway from this statement?
Yeah, very well said. That's exactly the point. So it's clearly a no landing scenario. In other words, if the debate in the market is hard landing, soft landing, meaning some recession, the point we're getting here from analysts is, well, we're not going to have a recession. There's no landing involved. It's just a slowdown in growth, and with a reacceleration.
It's an interesting correlation. I get you're asking me about the stuff behind me before we got going, and in the ultra marathon running world, we talk about constant forward motion. As long as you don't stop, you're still moving towards whatever goal it is, right? And I think one of the things I take away here from this comment is if earnings growth is still forward moving, then growth for our assets and towards our goal, whatever the goal is for all the folks on this or listen later, is that if that earnings is still positive and earnings is the underlying driving engine of equity gains and stocks are the engine of our car that's moving us towards our destination, then we can walk away from this dialogue. Another key golden nugget is if that is upward, then there's still gas in the tank to drive this engine forward over the near term. Constant forward motion.
Yeah, exactly. Well said. And so to extend then the discussion, what I've done here is to superimpose the S&P 500 index on top of earnings. If earnings drive stock prices, then what you would see is a almost perfect positive correlation here, which is exactly the point of the chart. And the S&P 500 is in black, the stock market is in black, earnings are in red. And so what we're suggesting here is that if earnings actually do come out to continue to rise, if the red line continues to work higher, then what do you think the black line's going to do? And the answer is, in my mind, the black line probably trends higher between now and the end of the year, assuming that earnings estimates don't get cut, something that I don't currently expect. But the point here is that the path of least resistance for stocks then seems to be higher based on this picture. The engine continues to make forward progress. Let's talk about valuation for a second. And I just pulled this chart this morning. You can see that the red line is the S&P 500 trading at 17.2 times forward earnings, which to me is perfectly reasonable valuation. And I'm just comparing the red line here to the red line in 2014, 15, 16, 17, and so forth. You can see how stocks did get overvalued in the last couple of years, but they've come down to what I think is reasonable valuation. And another question might be, well, why are you comparing to 14, 15, 16, 17? And the answer is, well, that was a period of time in which long-term bond yields were approximately where they are today, because bond yields have a lot to do with the market's PE ratio. And so in my mind, the S&P 500 is reasonably valued. It's neither over or nor undervalued on a PE ratio basis. But if you look at the mid cap and small cap indices, the blue line and the green line, that this is suggesting that stocks are pretty cheap based on the historic PE multiple for small and mid cap stocks. And so later I'm going to talk about staying broadly diversified in the market, but I think clearly this chart suggests you want to have exposure to small and mid caps, just as you have exposure to large caps, because at some point they will probably outperform large caps if history is any guide, and we'll see a recovery in these PE multiples for small and mid caps. Okay, let's shift gears and talk about Fed policy. Probably no surprise to anybody that Chairman Powell said it was very premature to think about pausing. The most recent action that the Fed took was a quarter-point rate increase, and the central bank slows its pace of tightening and signals another lift at the next meeting in March. Well, that next meeting in March is tomorrow. We're talking about a couple more rate hikes to get to that level we think is appropriately restrictive. And so this is the big debate right now. Will they raise again tomorrow, and what kind of guidance are they going to give in the context of this banking crisis? Good question, and I don't have the answer to that, but at least until this bank thing hit, most people were thinking another 2 quarter-point hikes, maybe 3, and we'll be done. Let's talk about inflation, because the Federal Reserve is trying to whip inflation, of course, by raising interest rates. Here is the most recent personal consumption expenditures deflator measure of inflation. You can see that it peaked and is headed lower, pretty much in line with the most recent Fed's central tendency forecast, the gray dotted lines. The CPI for February, you can see, peaked back in June of last year and has been steadily trending down, not quite at the rate of monthly change that it had been, but still it's continuing to trend lower. Here was a really interesting observation written by Alan Blinder, Princeton professor and formerly member of the Federal Reserve's Open Market Committee, so somebody that I pay attention to. And his point is that the CPI rose at an 11% annual rate in the first half of 2022 and a 1.9% annual rate in the second half of 2022. And then he says, no, that's not a typo, a tad under 2%. And the PCE deflator also crumbling from much higher rates of monthly change last year compared to most recent. So he's suggesting that inflation could head down a lot faster and harder than a lot of people are currently expecting. What about the money supply and the rate of change in the money supply? Monetarists believe that inflation is everywhere and always a monetary phenomenon, to quote Milton Friedman. And you can see that the rate of change in the money supply now is actually negative. And here is a monetarist interpretation of this data. And the punchline in this article is that if the relationship with inflation continues, core inflation will be at only 2.3% in June of 2023. And that's because the rate of change in the money supply is collapsing. This is Ed Yardeni's most recent inflation forecast. And I just wanted to point out that he's saying between 3 and 4% inflation in the current year. And who is Ed Yardeni? Well, he's probably the highest profile private economist today. And that's why I'm picking on his forecast, but his is pretty consistent with a lot of other high profile economists here in the United States that were headed down to something between 3 and 4%. It's not that Fed's 2% target, but then Yardeni says, yes, but in 2024 and beyond, we'll probably get back to 2% at some point.
Do you think there's any value in the Fed or any conversations the Fed changing that target inflation rate? You know, with what I see as what I see forecast, and maybe this has changed since last time I saw one, but as the labor force contracts in the United States with an aging population, do you think there's any discussion or potential that the Fed will change their target interest rate, inflation rate, to allow a little bit more flexibility in money supply and Fed policy?
You mean a slightly shifting the range to a slightly higher?
Yeah, a slightly higher range of inflation is a permissible event in our economy. Is that a potential here?
I tend to think not, but I also think that if we head back down towards 3%, as Yardeni is suggesting, the Fed will say, well, that's pretty darn good, and we'll be steady as she goes, just hoping for a variety of reasons that we head back down to 2%. Yeah. Let me just make this additional point. This is a quotation from a guy named Alan Detmeister, economist at UBS, who's a housing economist. And he's saying because the price, because of the change in housing prices and the contribution that makes to the CPI, as a result, he predicted inflation could be below the Fed's 2% target by 2024. Very interesting observation. So I just wanted to call your attention to some of these analyses that suggest that inflation can and is collapsing perhaps a lot faster than a lot of people had been expecting. I don't know if these analyses will prove to be correct, but they are certainly interesting. And let's just hope that we are headed in the right direction as time goes along. Now, just in the interest of time, we just a couple of more minutes, but shifting gears entirely and talking about investment strategy, my question has always been, there are all these very smart people that are interviewed on CNBC and in the Wall Street Journal on a daily basis, telling us to buy the tech sector or the healthcare sector and not to own utilities or staples. It's called tactical asset allocation. And it's very common and it's prevalent in the news media. And so the average investor is out there thinking, well, how do I know I'm in the right sectors that are going to outperform? And the answer is you don't know. But this study that I conducted over the last 13 years is very revealing in that it suggests that strategists are no better than throwing darts. There is no value to be gained by listening to so-called Wall Street experts in their predictions as to how the various sectors of the S&P 500 are going to work out. And I think it's such an important insight, because if you don't listen to experts in Wall Street as to where to place the chips on the table, well, then how should you go about investing? And the answer to that question is that I would listen to a guy like Richard Thaler, Nobel Prize winner for behavioral economics. I just wanted to call this interview to your attention. What investment opportunities should investors look for after the pandemic? And Richard Thaler says, it's not knowable. That's exactly the sort of thing we pride ourselves in not doing, trying to forecast what the world's going to look like 6 months from now or a year from now. And then he goes on to say, for individual investors, the best strategy is benign neglect. Create a sensible long-term portfolio and then ignore it. Wow. But you couldn't find better wisdom, investment wisdom than that statement. And so what we are all attempting to do in our business, and what Kyle is doing on your behalf, is applying modern portfolio theory. First of all, staying fully invested is so important to understand. That's a fundamental tenet of modern portfolio theory. It's this idea that trying to time the market is impossible, In other words, trying to beat the S&P 500 index with market timing is impossible. So you're best served by staying fully invested, stay broadly diversified, which today might include smalls and mid caps, as I was pointing out earlier, and then periodically rebalancing. When something really runs, take some off the table and put it back into the other asset categories. So modern portfolio theory is really the only academically tested approach to investing that makes sense. And this is what the most successful investors do in the long term. Warren Buffett, for example, is a proponent of modern portfolio theory. Well, that's all I have for you today. I appreciate your participation and the fact that you tuned in for this webinar. And Kyle, if you have any other questions, I'd be happy to try to answer them.
Yeah, I was curious. I don't know if I heard the answer. So first, let me say thank you, right? Again, every time I've heard you speak, you almost feel like I invited everyone along to something I enjoy, right? So thank you. So hopefully everyone on here has gotten something from it. The chat is open. We've got just a couple minutes left. So if you have any questions, drop them in the chat. I'd be happy to, or the Q&A, I'd be happy to ask Fritz that. So we had a real interesting thing happen with this conglomerate of banks coming in and so to speak, rescuing or infusing capital into another bank. And I was doing a little research back into 08 and 09, and we saw a little bit of that happen then. Certainly was a common thing pre the creation of the FDIC insurance back pre that invention. And so I was curious to get your take. This is a question one of our relationships asked. It's one I'm curious is, we've got one side of government intervention, right? Whether that may be increasing the FDIC insurance threshold or what may have happened. We're seeing those headlines this morning, to allowing or potentially, government agencies working together in collaboration to bring these partnerships. Do you think that's a better outcome long-term for our economy, is less government intervention and more private companies coming together to, banking centers to work with one another to mitigate risk, maybe of their what we're seeing as competitors before that moment?
Let's see. I think when we can make that happen, or when that does happen, I think it's good news. But I think probably there are instances in which having the federal government be the ultimate backstop is going to be inevitable, and you're not going to have private participation. I don't know. I don't know if I have a good answer for that question. As a matter of fact,
it's not. I don't think it's that black and white, right? I mean, to me, I think it's not a one versus the other. Like when I look at these things, I think one of the things that is meaningfully misunderstood is the implications of I think we think of the domino effect just in the banking sector, right? But take SVB, for example. One of the largest clients was Roku, the internet TV provider, right? The majority of their cash, 80-90% of Roku's money was SVB. I share that to say that I think sometimes we want something to be more straightforward. What's one versus better than the other? And I think each situation, each bank is unique in terms of its customers, its size, its scale, and its collaboration with other banks. So that'd be my thoughts on it, is it's just not that black and white. Say one's better than the other. So any other questions for me, for Fritz, while we've got him? Well, Fritz, I hope I'm standing between you and some downhill time, my friend. So I don't know if you plan to get back out and ski if the snow's still out there. But let me just say, on behalf of all of our clients that are on this and watch this, thank you so much for investing your time, your wisdom, your knowledge. Certainly a privilege to have somebody with your expertise and your tenure in this space share your wisdom. And to all those who are watching, thank you again so much for the trust and confidence you place, not just during these periods of uncertainty, but really over the years. I'm coming up on 20 years of serving families, not just here in Indianapolis, but across the nation now. And so I just want to say thank you for the trust you place in me. I take it very seriously, and I'm grateful for it each and every day. And I hope that this time with Fritz has been impactful, each of you who spent time here. So if nothing else for any of us, we'll wish you all well, rest of your day, and look forward to any questions that come from this presentation offline as well. Thank you, Fritz. Thank you for your time.